this is a good place to sort of go into, the last 40 years. And I think if we look at it, sort of value investing, risk adjusted returns, you sort of mentioned a little bit, and how it drives markets, and maybe how it's shaped our economy as well, especially, I guess, in the West more generally. So I'll be interested to hear how you see that.
Yeah. I spent a lot of time, I was trading, volatility at this Franklin income fund. It's a 60-40 portfolio. It's a $100 billion fund. And, what you did there was essentially you took equities and you overwrote those equities with call options to generate some more yield on your equity portfolio. And it was a short volatility strategy. So you essentially just, you're any pop in volatility in a stock that's not supposed to happen, you can sell calls and you generate a couple more percent to make the yield on that portfolio. And so that idea, it's the same premise as, what Warren Buffett, the life insurance model, where you take in premiums from, offering life insurance and you go reinvest those in a yielding asset. And so this was like the predominant, risk adjusted returns is the predominant, I guess, ethos for the past 40 years is like, I can just borrow from the short end and then buy something at a higher yield and I make that spread. But what you do for a generation when it's just, you don't invest in new things, you're basically just arbing things. And I think that's largely the Warren Buffett model is like, the value investing and yield type investing over a generation, it causes secular stagnation. And this is something that, Peter Thiel has absolutely nailed it's why he's in VC is because you want to invest in new ideas. There's usually technological unlocks that help grow the next generation for nominal growth. But we did this, I think it's stupid to risk adjust your returns institutionally and have it mandated. I get that as a boomer, you want to have less risk and save your money. But, when you do it institutionally through pensions, through endowments, and you scale this for a generation, you end up to the point where that building that you bought, that commercial real estate building that you thought was money good and it yielded 8% every year, bam, it takes a 75% haircut. And you don't, no one's in office buildings anymore because the economy changes because the next generation doesn't need it. And so this idea of risk adjusted returns, it's like, it might be flipped. So risk adjusted returns, short volatility, these were like the predominant ideas of the last 40 years. And what it did was it just took money from, the capital class took money from the middle class. And that's what happened. And there was a pocket of frontier investing and growth investing, but relative to the yield investing, it was like a drop in the barrel. And that's why we have such a hard time seeing nominal growth. Not only that, but the nominal growth, normally when people feel wealthy and they feel rich, they have children, and you can see it in the fertility rates dropping is the next generation is not getting wealthy because they've squeezed all the juice out of this, short volatility trade. And so my thing is the government, to make up for the growth, we're moving to fiscal dominance. The government is forcing you to invest on the frontiers. They're forcing you to invest in the growth sectors of the economy that have big TAMs. And they're literally creating infrastructure plans to invest in AI infrastructure, to invest in data centers, to invest in, manufacturing. And these are all the things that have been neglected for 40 years in short volatility land. So that's the end game is you have to stay ahead. And not only that, but now, the Fed is clearly out of the bag, diluting the currency. Real politics talks about it's like a 8 to 10% hurdle rate of dilution in your currency. So you actually can't get that return. Even in the high yield market, I think a high yield bond is it's probably at 6-7%. So if you buy that, you're losing 1% a year as a high yield bond, let alone some of the other stuff. So what are you going to do? Are you going to invest in a high yield bond at 6%? Or are you going to invest in something that, potentially has the government backing it, like crypto or Bitcoin or AI infrastructure stuff? One of my biggest themes right now is the AI infrastructure names, which are Bitcoin miners largely, is you can now issue you can issue debt at, say 10+%, which will get you that real yield as a pension. And that means these Bitcoin miners can use the debt markets to finance and not finance through equity or secondary offerings, which means their equities are now actually going up. And not only that, but there's like a long runway of growth for the AI infrastructure names, because there's not enough power for all the data and capacity and electricity that these AI hyperscalers need. And so that's sort of the things that I think you have to think about risk differently here. If you want to just be beta neutral, I don't think that model is going to be working in the next 10 years with where the government's at. And you really have to revisit what risk means to you. And buying a bond and sitting on it, maybe it makes sense to for a boomer. Like, one of the things I've been talking about lately is Vanguard is saying, hey, have a 70% allocation in bonds. That's what you should do. And maybe if you're almost dead, that's a good advice. But like, no one in their right mind, especially after Powell's speech, would ever put money in bonds. Like, I think bonds are like a way you lose money slowly. So it's almost like where you park your money just in case, until you know what you want to do with it next. And so like for offering a 70% allocation in your portfolio to bonds, it's like, you're just going to lose money. Like, here's a way to lose money slowly, and I'm going to charge you a fee for it. Like, how upside down is that for a business model? And I think it's all generationally changing here. And you can see it in the politics. You can see it, there's a whole ethos changing that our generation is now getting more vocal about it and saying, this doesn't make sense. Like, none of this makes sense. And that's, then we look at Bitcoin's up, it's almost near all-time highs. And that makes a lot of sense to me because all the other stuff does not make sense. So that's why I effectively call it a Ponzi scheme.